Cramton. He teaches in the economics department at University of Maryland in College Park, but he also now has a joint appointment over in Cologne, Germany. And so he's teaching in economics, but his PhD is in business from Stanford, and his undergrad was in engineering in operations research and industrial engineering at Cornell. So he spans a lot of different areas, and he has helped design the auction markets for things like radio spectrum and carbon, and of course electricity and natural gas, diamonds, medical equipment all over the world. So Australia and of course Europe, here, Canada. So he works with a lot of different people, and he sits on the ERCOT board, the Electricity Reliability Council of Texas. So that's what brought him to Austin this week. Is for 2 days they brought all of their board members in, and so then economics got their hands on him, and I was lucky enough to find out that he was going to be here this week, and he offered himself up to speak on any topic. He can speak on many. So today he's speaking about electricity market design, which he's for many years helped ERCOT with, and renewables as feedstocks. And tomorrow at 3:30 over in BRB, which is I think part of the economics group, they'll be having him talking about road pricing, so bringing some of these ideas to road pricing, which of course has very variable demand and could use some market intervention. So thanks so much for coming out here and letting us hear from you today. It's all yours.
Thank you.
Or, you have
Actually,
your own?
I've got my own.
Okay.
Thank you, Kara. It's a great pleasure to be here and to talk about electricity market design and renewables. So there's a big transformation that I'm sure everybody is aware of. We're right in the middle of it. And what I want to talk about is electricity market design broadly as we have it today in sort of the state of the art, which is in large part the Texas market I'm going to focus on. But we have a very nice electricity market design. And I will talk about how that design may or may not need to evolve as the percentage of renewables expands, which it certainly will as we move forward. When thinking about market design, any market design, the place to start with is the objective. And in electricity, the objective is simple: reliable electricity at least cost. And I like breaking it into two components. Short-run efficiency, which is making the best use of the resources that you have today, making sure the right units are generating and the electricity is being consumed by the right parties. And that is a challenging problem with electricity because of all the constraints there are. But it's one that we've worked on very hard and is largely a technical problem. And I think that we've essentially have this one pretty much solved, at least in the near term. Long-run efficiency is the great challenge, and that is inducing the investment, the right investment. So you've got the right amount of resources and the right mix of resources. And that is the big challenge, and that's the big benefit of a restructured market, where the guys making the investments are on the hook for those investments, and if the system is designed right, you're going to induce the right investments, and everything will work out nicely. And if people make bad decisions, then it's going to be their fault. If they make good decisions, they're going to make more money, and that's a good thing. There are many challenges in electricity, and it is, and yet there's many rewards too. And in fact, I think in terms of market design, we've made more progress in electricity than virtually any other area. And partly it's because you can't mess up really badly. Because if you mess up really badly, the lights go out, and people don't like that. So you're almost constrained to not messing up too badly. And that helps a lot. And then the physics of it, basically you can't, the politicians can't say, well, damn with this physics, we're going to ignore it. These are, it operates on certain rules and they have to be obeyed. So the basic challenges that we confront is that we have to balance supply and demand at every point in time. We've got lots of physical constraints in the network and with all the resources, And there can be very large shocks in supply and demand, but especially large immediate shocks in supply when there's outages of transmission lines and generators and so on. And then once you introduce a lot of renewables, you have these intermittent sources of supply, wind and solar especially, which you can't count on all the time. And so you have to take that into account. Another challenge is the absence of demand response. Consumers typically, retail consumers at least, typically neither see nor feel the real-time price for electricity, and that is a challenge. That is starting to change, and so one of the major enhancements is going to be the development of a robust demand side, and that will be very important. But the problem with the absence of demand response is that we can have shortage, and we have to we have to deal with the possibility of shortage, and so the market has to care about reliability, and in some sense act in a more paternalistic way with respect to the consumers of electricity. In the future, when we have a robust demand side, then we won't have shortages. Demand will simply look at the price and say, at that price, I don't want as much. And that will address and then we'll have a supply and demand balance and everything's fine. The consumers will directly be able to express their preference for the consumption of electricity. But most of us today don't do that. Although technically we certainly could. We have the technology now. It just isn't built into the system yet. And the final thing I'll mention is climate policy. That climate policy is very important for anybody investing in generators. If you're going to spend $1 billion on generators, you'd really like to know what the carbon price is for the next 30 years. And our current climate policy makes it very difficult for the investors to make that determination. Because whether you're going to build wind or solar or natural gas or coal, nuclear, all of those have quite different economics based upon the carbon price that you ultimately face. And that's yet to be resolved. So that's a very challenging situation for the investors. The key to a successful market design, in my mind, first off, is getting the spot market right. And the spot market is all about is short-run efficiency, making the best use of the existing resources. The spot market in most of the markets, actually all the markets in the United States, consists of two components, a day-ahead market and a real-time market. Other places in the world might not have a day-ahead market. The day-ahead market is for unit commitment and scheduling. So it's basically a day-ahead planning market. It's a financial market. The parties take positions. I'll talk about it more in a moment. Then once we get into the day, that's the real-time market, hour by hour, minute by minute. And there, the system operator is sending out price signals and dispatch instructions to balance supply and demand in real time. And those two combined are the main instrument for the electricity, for the wholesale electricity market. Now the consumer market on the retail side is quite different, but those that are providing the retail service are very much connected to the wholesale market, but they provide indirect connection to for the retail customers. And then finally, and I'm going to be focusing not on the retail market, but on just the wholesale market. Finally, forward trade. So the ability to trade forward is very important in order to manage risk and make plans, and make the spot market work better. And that's going to be a recurring theme in my remarks today. So now let me go into some details, and I'll come to renewables sort of throughout, but especially at the end, I'll focus on the renewable element. The first part of the talk is largely about sort of the state-of-the-art in electricity market design. The day-ahead market, as I said, is unit commitment and scheduling, and the products are energy and ancillary services, reserves for every hour of the day, and the day-ahead market is financially binding, so it's people lock in prices and quantities financially, but it's not, and some of it is physical, it's tied to physical resources, but the commitments are all financial rather than physical. The day-ahead market is especially useful for fossil resources that take some amount of time to get started. And for these resources, they can enter what are called three-part bids. There's startup cost. A coal unit might cost $80,000 to start up, so it's not inexpensive. Minimum energy cost, it has a minimum energy that it has to provide, and that has some cost. And then the marginal cost, the energy offer curve, giving its marginal cost, which is just a supply curve. The market also allows what are called virtual offers and bids, and this actually is a very important component. So these are just these marginal cost bids, and essentially what they're used for is to arbitrage between the day-ahead and the real-time market. So for example, if you think that the real-time price is going to be higher than the day-ahead price, then you would want to shift your sale to the real-time market. What this allows is you still get to bid, if you want your unit optimally scheduled, you still get to bid your unit with its correct or its true economics in that three-part offer. It gets optimally scheduled, which is great. But then what you want to do, since you think that the real-time price is going to be higher, you actually want to shift your financial sale to the real-time market. And so what you do is you buy so in my three-part bid, that's actually going to consist of a sale. And so then I want to buy back in with these virtual offers in day ahead to sort of cancel my sale through the three-part offer, and then in real time I will finally make the sale at what I think is a higher price. So that's actually the virtual bids and asks are very helpful in letting folks do that. It also, they have an additional benefit in that these virtual bids and asks are all what we call convex bids. So they make the problem more convex, and that makes it more likely that we'll be able to get nice linear prices out of in each day and every hour that support the trade that the day-ahead market proposes. I'll talk about that in just one second. So basically what we're doing is we're solving this big optimization problem. Once we let the market participants express both on the supply side and the demand side, they express their preferences. We run this big optimization every day to determine an optimal schedule that maximizes social welfare subject to all the constraints, co-optimizing the various products, energy and reserves, and calculate these linear prices, which are essentially competitive equilibrium prices that support the trade that happens in the day-ahead market. And all that is very nice and actually works very well. In Texas, this market is a voluntary market, so you don't have to participate, but a lot of people do. So there's a lot of, it's a very liquid market. About half of the real-time volume is, participates in the day ahead. As I said, things like these three-part offers introduce these non-convexities, like the startup cost. And so we do have to handle those in some way. And what we do in the US markets is we make whole payments in the event that over the day your revenues do not compensate you for your as-bid costs. And that works very well in that most of the time, since you're optimally scheduled, you're actually getting revenues that do cover your as-bid economics. And so these make-whole payments are very small, and the linear prices work very well. One of the things I really like about the day-ahead market is it's very pro-competitive in that if you're a small guy, it's a lot harder for you to optimally schedule your resources on your own because you don't have the information about what everybody else is doing. The system operator has all that information and can optimally schedule you. And so this is very net. Whereas if you were a large energy company with a huge portfolio of resources, you can self-optimize your resources and be not too far off. But really this is very important for the smaller generators. And it's also very important for them to be able to hedge real-time price risk in a liquid market, and the day-ahead market does that. So some markets, like in Australia, they don't have a day-ahead market, and I think that one of the reasons they don't is that the large incumbents actually don't like having this pro-competitive piece of the market that enables small guys to get optimally scheduled and hedge real-time price risk. One other component is that for those, as I said, the day-ahead market is voluntary. What's not voluntary is you have to tell the system operator what your plans are. And you can change your plans. Circumstances change and you decide to do something else. And you can change everything up to 60 minutes before real time, but everybody has to provide plans. And that's necessary for the system operator to manage the system. The ancillary services I've mentioned already. They're basically there so that the reserves in the waiting, in the event something happens and they need to call on, one unit goes down, a transmission line goes down, and they need to do something quickly. And so some of these reserves are very, very fast, like regulation, that maintains the precise supply and demand balance second by second. So these are all computer-controlled resources, and then the others are slower, like within 10 minutes or 30 minutes. And these are the sorts of things that will change as the energy mix changes. So if we get a lot of renewables, that's going to put more pressure on flexible resources, and we will possibly need additional reserves or different types of reserves. And so the quantity of reserves is something that's reviewed periodically and adjusted as needed as the system changes. Ancillary services are actually not a huge part of the bill at the end of the day, but they are an important component of revenues for the generating units. And you can see here this is the real-time price in blue, the day-ahead price in orange, and these are the ancillary services. And so they're much lower than the energy costs, but of course these are reserves, so you're not actually burning fuel when you're providing these ancillary services. And here it is in the impact on the bill. So in Texas, we're around, last year we were at about $25, just under $25 per megawatt in the wholesale market. And the ancillary service component is actually fairly small, and that's because you're actually not getting such a high quantity of ancillary services. The real-time market is a security-constrained economic dispatch. It determines the optimal dispatch of the units, the least cost generating first, and sets prices every 5 minutes. This is both financially and physically binding. And this is a really nice market because it enables the participants to efficiently settle any deviations from the real-time plans. So it's it's very nice. It's to have this, and there are really very few markets that have this efficient settlement of forward positions. So simply and beautifully accomplished. Now, the U.S. markets all have this very liquid real-time market where all the units participate in the real-time market. In some other places, like in Europe, they tend to have much less, they don't even call it a real-time market, they just call it a balancing market. It's voluntary, and it's a limited set of resources that offer in the balancing market, and the prices are more chaotic and doesn't work nearly as well as what we have here in the United States. Here's some data from the entire period of the nodal period, which started in December of 2010 and continues to today in the Texas market. This is the real-time load over this period, and here's the volume that's traded in the day-ahead market. It's roughly about half, a little bit more than half of the real-time. And then this shows the prices, both day-ahead and real-time. The day-ahead is in blue, and then the more spiky is in orange, the real-time. And it's very natural for the real-time market to be more spiky because as you get close to real-time, you have fewer options, and so it's more expensive for parties to respond. So that's a universal feature. What should happen is the day-ahead price should be the expectation of the real-time price. So we should actually have price convergence. There's going to be periods where there's differences, of course, because things don't work out in real time exactly as, the day-ahead's just the expectation of real time. And so you do see some variation here, but on average it works out for the day-ahead to converge to the real-time. When thinking about market design and evaluating the performance of market design, it's very helpful to look at stressful events, stressful times. And so here I'm looking at Texas in the summertime. That's the period of stress in the Texas market when all those air conditioners are on. So here's load in gray. Here's, in blue, we've got the real time, which is very spiky, and the more stable day-ahead price. And one thing this is 2017. And in fact, in 2017, the really big stress event actually came right here at the end of August, which I suspect some of you might remember, Hurricane Harvey. And that was very stressful for a lot of folks, but it was very stressful in the electricity market because you had transmission lines that suddenly looked like that, or substations that looked like this. So there was a lot of destruction, and yet the system, and so you would think that actually, wouldn't the system break down under such an event, and it would just turn to command and control, or all the lights would go out? And in fact, what happened is, no, it never went to command and control. Everything worked fine. The system, the wholesale market kept sending price signals. The operators of the generating units would respond to those price signals, and it was, quite remarkable. Certainly there were people that lost electricity, right? A lot of distribution systems were adversely affected, and but the wholesale market overall worked perfectly fine. So that's a very nice test to confirm that this market is actually working pretty darn well if it can withstand something like Hurricane Harvey. I'm going to come to another test case, which was this summer, but in a moment. A few more slides away. Now, as I mentioned, we have limited demand response today, and so there's this possibility of shortages. And there's this question of then, well, what do we do with pricing as we approach shortage situations? And what we do in Texas and now all the other markets in the U.S. is have something called scarcity pricing. It takes different forms in different markets, but this is what it is in Texas, where we we actually step in and set a very high price in these near shortage situations or shortage situations, and that's actually very good. It's essentially the demand. It's our paternalistic view of demand's value of energy, and it's embodied in this operating reserve demand curve, which this is the value of lost load, which in Texas is $9,000. So very big number. Remember, electricity was about $25 in this market, so 9,000 is a big multiple of 25. And the idea is this is the quantity of reserves that you have. This adder coming from the operating reserve demand curve, it's at zero when we've got lots of reserves, but as those reserves fall below 4,000, then it starts to go up, and at this point, we're almost probability one going to start shedding some load in order to maintain system security. And so the price goes all the way up to $9,000. The important aspect of this is it motivates some very good behavior on the part of the market participants. In particular, it motivates a lot of hedging activity in order to protect against this $9,000 price. So the demand side engages in a lot of forward contracting so that they are not in a short position when they go into the real-time market. And then they're fully hedged against this $9,000 price. And similarly, the generators then can make these forward sales, and they're better able to accept the real-time. They lock in a price for their, but there's this possibility of the $9,000 price, but they've got their unit, generating unit, and their fuel contract to protect, to sort of as a physical hedge to protect them from these very high prices. So all that is part of the forward contracting that really is essential to manage risk in the market. And if we think back, markets fail when there's a shortage, when the counterparties go belly up, as they did in California. And so it's very important to have this hedging to limit risk in the market and make sure that all goes well. Now, the other example that I want to give is from this summer of a stress event. And the stress event this summer, what we're looking at here is the reserve margin, how much extra that the system has beyond what it needs at peak. And you can see we've got a very comfortable, this is our target reserve margin, about 14%. We've got a very comfortable reserve margin from 2013 through 2017, especially in the last 3 years. And here we had quite low prices. But look what happened in December 2017, when we're looking at what our summer reserve margin is, it's less than 10%. So people were nervous. And that nervousness led to coming from the demand side, wanting to be hedged, engaging in forward contracting. It led to a lot of upward pressure in the forward price. This is the August price in 2016, 2017, and 2018. And you can see here the forward price, when we were sitting in May, we had forward prices of $250, way above any prices we've seen in the market for for an entire month. And so that's actually the market working, because the generators then, motivated by these high prices, sell forward more energy. They also make sure that their units are well prepared to operate in July and August in 2018. And so here they are taking planned outages in April and May, making sure their units are all tuned up, ready to go when they're going to be needed in July and August, when all the air conditioners are on. And so what we had is much lower outages in July and August, and that was one reason that everything worked so well. There were other factors too, such as the August was cooler than it sometimes is. July had some hot days, and as a result had a high day-ahead price, but things worked out because everybody was there. And so this is the day-ahead price. This is the real-time price, much less, averaging for July. And that's because things worked out. There weren't any problems. There could have been problems, but they didn't materialize. So that was very nice. This is the peakiest. This is when we hit our a record peak on the 19th of July of 73 gigawatts. And you can see at the peak during the day, every unit, light gray is the offline units, all units are on. Everything is running. They're ready to go. It's just as it should be working in these extreme peak conditions when people are well planned. Here are the outages in green, teeny, so hardly any outages. One nice thing, this is wind in orange, so now I'll talk about renewables. So, one of the problems with this wind here is it's dropping off just when we have the peak in load. Red here is load. But one nice thing, this is solar. So solar is kicking in exactly when wind is falling off and when load is expanding. So solar and wind are actually very nice complements here, and that's a good thing. And solar right now is very small, but in the future, it's got lots of potential for growth. So in the future, solar is going to be much, much, much higher. ERCOT is what's called an energy-only market, where we're basically relying on that spot market, day-ahead and real-time, plus all the forward contracting in order to send the price signals to induce efficient investment. And we're hoping that scarcity pricing is essentially the one control the regulator has to stimulate further investment. So setting that $9,000 price, setting that price at $9,000 instead of, say, $1,000, $1,000 would induce less investment than the $9,000. We're hoping in Texas that that's going to be enough to make everything work. And so far it has. It's a nice investment environment. Everything has worked out very nicely. But other markets where the investment environment is a bit more challenging, such as the East Coast, have a capacity market, which is another formal market which is a long-term investment market taking place several years before an obligation period so that new entry can compete to provide this capacity product. And the capacity product, I don't have time to say too much about it, but essentially the product is the ability to deliver energy during scarcity periods. And it's very important to have strong, it's not just iron in the ground, so the physical capability, it's actually got a financial component as well, with very strong penalties for failure to deliver and strong rewards for delivering beyond your obligation. This has the advantage of coordinating investment, so avoiding a boom-bust cycle of investment in generation, which can be nice. But they've historically been difficult to implement well, and so it's sort of a mixed story of the success of capacity markets, and Texas at the moment is quite happy that it doesn't have one. Yeah?
So don't we list
Yes.
maker like ERCOT, but don't we
Right.
even further out than the 3 years?
Yes. Yeah. So basically, yes. Yeah. So to repeat your question, isn't the forward contracting a substitute for the capacity market in Texas? And yes, it absolutely is. And and it can work actually very well if there's enough motivation to engage in that forward contracting. And in Texas, it does work right now. Now let me turn to renewables, and then we can have more questions with microphones passed around so everybody can hear. So, in fact, not almost all, but much of the new build in the last many years has been renewables. Predominantly wind, although now it's shifting to solar in a big way as the solar cost has come down dramatically. Coal hasn't been built for years. Really, in the last coal to come online in Texas was 6 years ago, and that was probably starting to be built 10 years ago or more. And that's true throughout the United States. So one thing about these renewables, wind and solar, is they're intermittent, they have no inertia, and that's challenging for the system. But what we found is so far today, everything's worked just fine. And partly it's that there's enough gas resources that have flexibility to handle even very significant quantities of renewables. There's hours in Texas where over half of the energy is generated by wind. So, Texas is blessed with lots of wind and solar in addition to lots of gas. So it's really, quite a nice environment. This is not Texas, that's South Australia. But on the right, it is Texas, and the interesting thing, the wind resource is so good that even, this is year by year, the ever-increasing quantity of installed wind. As we're doing more and more, remarkably, the capacity factor, how much energy comes from these new resources, is going up more and more on a percentage basis. And so you'd expect that the early build would be in the best areas with higher capacity factors, but in fact, because of better technology and the abundance of good wind resources, the capacity factor has continued to increase with each year. So that's good news. And solar, we've just barely touched the capability. So there's going to be lots of action there. But one thing to point out is large changes in the resource mix do not happen overnight. They happen slowly. So when we look at the energy output and who's producing the energy, even though for the last 6 to 10 years, most of the new build has been wind and solar, the energy is predominantly gas with some coal. And how much coal is very much a function of what the gas price is. So we don't have to worry about things changing instantly, and that's a good thing, because that means to the extent that any market design changes are needed, we have time to make them. They don't have to occur in minutes. We actually have years to make adjustments to respond to changes. One of the changes is that the wind and solar have zero marginal cost, and another is no inertia, and those are both issues. The no marginal cost is an issue because right now the energy price is coming predominantly from the supply side. The demand side is largely inactive, and so it's the supply side that's forming the price. And if all resources had zero marginal cost, it would be difficult to have price formation. And so,
Sorry,
yeah.
last slide for the U.S. total production?
This is for Texas. Yeah. Yeah, that's just Texas. So when we have enormous, and other markets also have had, although Texas has as much wind as anybody right now, and no problems handling it because of the gas. But looking forward, once we go above 80%, then it's going to be more and more difficult to run the market in the normal way. Still, I think that the core design should work very well. We're going to have much more active demand side, though. That's probably the biggest thing. The demand side is going to have to start participating so that we get some price formation, more price formation from the demand side. And this will happen. We already have smart home technology that can control our appliances and manage our demand and can certainly be tied to the real-time price. So that is going to come. It's just going to take a little while. And then the other thing is with respect to flexibility, in addition to the gas resources, battery storage is going to be increasingly important as the costs come down. And that will be a very good thing. And they will come down, but it's going to take some time. And thinking about the market design overall, it's important to think about these things in a technology neutral way. So not to basically let the market decide, the market forces decide what are the right resources. And we just have to be very careful. So we don't want to exclude any particular technology when making the rules. And at the same time, we want to make sure that the true value of the resources is properly reflected in the products that we're trading in the marketplace. One thing that would greatly stimulate, and this is a radical idea, but this would greatly stimulate demand response, and that is if the system operator were to offer a default contract, retail contract, that exposed the retail customer to the real-time price. And this actually, we do have retail providers in Texas that do expose you to the real-time price, but you have to opt in to get that. You pay $10 a month and then you get the wholesale price, which is actually really nice because the wholesale price is much lower than the typical fixed retail price that you're paying. But this is a little bit different in that it's a default retail contract. A lot of consumers are lazy, and so they would choose this by default. but it can be made more manageable for the consumer by having the system operator or a retail provider buy forward based upon expected demand, and then but they'd still be exposed in real time. The real-time price would be used to settle any deviations from their expected demand. Finally, the climate policy, and here I've already mentioned the challenges for investors and how important having some understanding of the carbon price for the next 30 years is to making sensible investment decisions. And this is something that every country has to work on. The U.S. is certainly one of those countries that has had a lot of politics and ups and downs, and essentially the whole world has struck out for the most part with respect to sensible climate policy. But for me, thinking of electricity investment, the core element is the carbon price. And so I strongly advocate a focus on the international negotiations on a global carbon price. So to conclude, and then we can have some questions, electricity market design is a wonderful application of market design where we've made lots of progress. We now have highly efficient spot markets. We have good forward markets in the best markets. We have competitive retail suppliers. So all of those are very good things. And I think that one final element is the importance of good governance in order to make sure that the market designs evolve in an effective way going forward. Electricity is in transformation right now. It's not the boring old days. And so we're going to have to do some fine-tuning in market rules, and governance is going to be important for that. So let me take questions at this point.
I was wondering about the month ahead. I thought there was something further ahead. And so are there some deals being negotiated weeks ahead? And what percentage of Texas market is that?
Yeah, so I would say we don't have complete visibility on all the forward contracting in the United States. But I do have some information on that. And I would say essentially about 85% of energy is traded before day ahead. So most energy is...
because they have to schedule their crews and things like that, right? People on site to run the plant or something. So. Right,
yeah,
okay.
Yeah. So there are, in terms of where the volume is traded, I don't have perfect information, but I would say, yearly contracts are very common. Monthly, multi-year contracts are a little less common, but certainly do happen. So a lot of volume, I would say a majority of the volume, the vast majority of the volume, is even traded more than a month ahead.
Great. And how does demand hedge against that $9,000 per megawatt hour price? You mentioned that demand hedges. Is it just big industries that can turn themselves off, or is it?
No. So demand hedging, especially retail demand, is all through forward purchase. So they're hedging simply by forward purchase of their expected
consumption. And who does that? I mean, it wouldn't be a residential individuals.
So it would be your retail provider. So your retail provider is engaging in forward contracting.
So would that be Austin Energy?
Yeah. Oh, yes. Yeah. Here, it'd be Austin Energy.
Okay. Thank you.
Yes. Yes. Yeah. And actually, that. Yes, yeah, so the air conditioning control actually is a very useful form of demand response. And yes. Yeah, so they just step in and they cycle off your air conditioner at those critical moments where it would have been a $9,000 price, but for the fact that they cycled off. For the industrial customers, the large industrial customers actually actively participate in the market, and they just will shut down if the price gets too high.
This kind of dovetails into that from the demand response side. Instead of just manipulating your own load, now in some of the RTOs they're looking at whether demand response should be considered an offering, such as the various kinds of generation. I don't know what your opinion is of that and how feasible it is
Yes, so
today.
Yeah, so on the East Coast where they have capacity markets, the demand response participates in the capacity markets. So they do, sell their response on a forward basis. And I think that makes tremendous sense, and it's actually led to a lot of demand response in the East Coast, more so than in Texas. But you can still have the same thing in the energy-only market as part of the forward contracting, and the plans that Austin Energy giving you a discount on your rate because they're controlling your air conditioner during these critical times. So yeah, all of that I support 100%. And this is really where we're going to see a lot of development in the next 5 to 10 years. And it's going to ultimately lead to a state where we don't have to be concerned about reliability because we're really just going to balance supply and demand. And there's enough response on the demand side that all will always work well. If I push the price high enough, enough people will be not interested in consuming electricity that I can balance supply and demand and I never have a shortage. And so that's the ultimate state we want to get to as quickly as possible.
Let me have maybe a slight follow-up to that. Your future vision of a high renewables penetration is essentially that consumers have to start setting the price for the market because the supply is all zero and the demand response is essentially part of that process. So in Texas, I guess, what are the challenges, or are there any particular challenges you could expand upon further from what you just said about aggregating demand in a retail choice market like Texas? Challenges for aggregating demand response, or do you have to aggregate it, or how much do you have to aggregate it? Is that something the retail provider does, or does the individual consumer have to be more involved?
So the aggregation is very important, and it certainly happens. These retail providers, they do aggregate customers, and they understand their customers. And as long as that's the way these demand response products have been developed on the East Coast, is basically if you understand your demand well enough and can statistically show demand response, then you can get compensated for it. And that's so that's very useful. Now, it can come in lots of ways. It can come through your retail provider. It can come, and it likely will come through your retail provider and offering you various plans. And in addition to plans, there'll be devices like your smart home device. And that smart home device is going to have algorithms that will control your appliances to manage your demand in response to price in a way that's consistent with your basic preferences, which might be very simple. So your device might have a few buttons, like a green smiley face and a yellow and a red, that indicates how happy you are about having the appliance engaging in more aggressive demand response and thereby savings for you. So it needs to be very simple for the retail consumer, but can be quite sophisticated overall.
Thank you so much for sharing your expert insights with us and being with us. Can we talk about storage?
Yes.
So it's clear behind the meter, demand charge management, that business model. And so there was a proposal 5 years ago by Encore, and the difficult thing in our existing ERCOT market structure is how do you allow value stacking to help make the economics work. So do you have some models about storage? Would they be another vertical? You know, not only we have a competitive generation, we have wires and poles that are regulated, and we have retail. Would you create yet another some kind of entity there, or what's your idea of how storage could be rolled into our market structure?
I think we haven't yet worked out exactly what the best way to handle storage is. It would be really nice if we could handle storage within the framework that we have, and storage would be appropriately compensated for all the wonderful things that it can do. This is a very vivid example of storage. This is the largest battery in the world, at least it was on December 2017. This is the 100 megawatt Tesla battery that Tesla brought in very quickly into South Australia. South Australia. Yeah, within, like, I don't know, was it 30 days? It was 90 days. Yeah, 90 days or it was free. And they got it in. And it immediately provided a very valuable service for supporting the transmission grid. And so that's the tension, is that this kind of battery can provide transmission benefits that are separate from the energy and reserve products. And so I don't have all the answers right now, but I do know that having a very sensible approach with respect to the remuneration of storage and the regulation of storage is going to be quite important going forward. Especially as the cost of storage falls, which I think it surely will.
I was just going to ask for an explanation of that fascinating slide, so I'll yield to the next person.
Yeah, and as you can see, this is right with a wind farm, and the battery is especially complementary with wind and solar. Because you get to address immediately the big problem of wind and solar, which is the intermittent nature. And then actually the other thing is the battery actually, although the wind and solar have zero marginal cost, the battery has a opportunity cost which will come into the price formation, and that opportunity cost is because of its limited energy capability. So this thing, it's 100 megawatts, but I think it's like 129 megawatt hours. So if it's going at 100 megawatts, it can only go for a little over an hour.
Yeah, I was wondering what your recommendation would be for our policy in the U.S. for that carbon dioxide equivalent price per ton. Would it start at 30 and go up every year at about $10 per ton, or?
Yeah, that's something like that. You know, I think I'd start at 40 and go up.
Right. And would you do that around the world, or do you think you'd have lower prices in lower income countries and developing world, or?
I would have a global price and have a green fund that would compensate.
So that 30 or 40 would apply everywhere.
Yeah,
okay. Okay. And then the mathematics of what you're doing, I'm sure there's some behind there. Is that papers that you've written that we should look for if we wanted to apply these techniques in other markets, or?
So there's lots of papers. There's all the combinatorial optimization that goes in, and that sort of stuff is not so much in. I have a book on combinatorial auctions that has some material there, but there's pretty big literature.
And
now,
do you use like GAM Cplex for handling
so
that?
they use, I mean, my stuff, I use Cplex and Garobi, which are the two big commercial optimizers. But in electricity, the ERCOT uses, they tend to use much more specialized tools that are quite specific to their unique problem and are just very tailored. But they do a lot of combinatorial optimization. ERCOT has 3,400 servers, so basically 2 server farms working on optimizing the units and determining the prices and doing all the settlement. So it's very computationally intense.
That brings up a question. If in order to solve all these markets, will ERCOT servers have to shed their own load so that they can meet their own demand to calculate what the prices are supposed to be in the next second? Maybe we haven't yet chased the tail there yet.
They do have backup generation too, and for
Okay,
these
wondering
servers.
when we get. All right, I'll end on maybe one last question. You mentioned I don't know, an inertia question. Inertia's low with renewables. Maybe the future of high renewables case is a highly demand response world, which is, I guess, it's sort of a non-inertial response. So how do we get from here to there when ERCOT in particular talks about some minimum level of inertia that they like to deal with, say, the nuclear plant, being able to deal with, say, the nuclear plant going offline? What are the challenges for not needing inertia, or how do you not need physical inertia?
Right, yeah, so our current system does rely on inertia in order to operate, and it's essentially, if you didn't have inertia, then when there's some big outage, things would crash and burn. It just wouldn't, it would fail. It's the inertia, the fact that the things don't happen quickly because there's all this inertia, this big spinning machine. And so in that future world, as we get more and more resources without inertia, now wind can actually create some amount of inertia because it's also spinning, and there's things they can do that create virtual inertia that work, or artificial inertia, I forget what it's called. So they can get some that way. The reality is, for a very long time, we're going to need some amount of gas units that will be providing inertia as well. And then once you have more and some very flexible resources like this battery, you need a lot less inertia. And so that's why, another element that the battery brings into the mix. So we just don't know whether we will acquire an inertia as a product, or whether it's going to, and my guess is it'll be some time before we see inertia as a binding constraint in our system. But yeah, right now we need a particular level in order to have comfort that we can withstand outages.
All right, thank you, Peter. Thank you for the talk.
Good.